Can everybody hear me okay? I'm not sure if this, okay. Cool. So Global Capital Markets, we're a mid-market investment bank. We typically look at transactions between 10 and 250 million bucks. So typically it's later in the game when somebody's looking to raise significant growth capital or exit the business entirely. We're industry agnostic and have a broad breadth of experience, but it's generally later stage.
Yeah, and I would say similar to Connor, we are relevant later stage. So at Lafayette Square, in our credit business, we do direct lending to middle market size businesses. Think later stage, EBITDA north of 5 million is kind of where we like to play. And a lot of our use of proceeds will be towards M&A, growth capital, things of that nature.
Okay, Armel, let's start questions with yourself. What's the difference for someone when they take a loan from a private lender like yourself versus from a bank?
Yeah, thanks, Sean. So I would want to start by level setting in terms of what a private credit fund is, because I think it's something that's really started to emerge more and take off since 2008 during the last great financial crisis. With regulation and kind of the continued consolidation of banks, non-bank lenders such as private credit funds have really started to emerge and be a big player, especially within the middle market. And just like any other fund, right, a private credit fund raises money from investors, LPs, and our job is to go ahead and make a return for our investors, and we do that by investing in businesses via debt financing, right? And in terms of some of the big differences, I would say some of the key ones that I can think of are from an underwriting perspective, flexibility, and as well as approach. With us, just as an example, when we look at a business, we have the ability to go from a leverage standpoint up to 6 times leverage, whereas at a bank, generally speaking, you're looking at more like 3 times.
When you're saying leverage, what's that leveraged against?
Yeah, leverage to EBITDA. So good question. Thank you. So debt to EBITDA. And so, because we're not a bank, we don't have the same regulatory, standards, if you will, that banks will have. So that's one. And, there's a few others that I can think of. For instance, we wouldn't require a personal guarantee. We aren't heavily looking at the collateral as banks may be doing. We're really looking at the cash flow and enterprise value of the business. Not all credit funds are the same, but that's how we like to operate. There's other credit funds out there that are maybe your more mezzanine funds or other real estate focused funds. But for us, that's how we approach things.
And then Mark, question for you, background in venture debt. Can you tell us about when does venture debt come into the fundraising process?
Sure. So, to piggyback a little bit on Armelo, as he said, a private debt fund is a fund that's raised from investors who are looking for a return. When we're a bank and we're out there lending out the deposits that people put into our bank. So there's a little bit different fiduciary that we have there. We do work with private lenders that are in our venture debt space as well, and they can typically do some things that are a little bit earlier, maybe a little bit riskier than the bank would want to do. Venture debt it's a very timely topic to be talking about it because, up until a couple months ago, we were just sort of sometimes invited to the party. It's like, oh, well, it's kind of nice. Yeah, well, we should think about venture debt. Yeah, okay, that's kind of a nice to have. But as things have changed and as the leverage has moved from the founder towards the investor, venture debt is looked at totally differently. We're now kind of, the popular kid at the party because people are starting to look at venture debt as a way of extending runway. And, as the market's been changing and investors are talking to their portfolio companies, cash is king. And how much cash do we have and how long is that going to keep us in business? So if you're raising capital with the idea that we're going to get 18 to 24 months out of this equity round. We can put venture debt on top of that, which typically is somewhere between 25 to 40% of the equity that's been raised. And then now, hey, instead of 24 months, maybe we can get to 30 months, maybe we can get to 36 months, and we can have a little bit more time to get to that milestone, which is going to give us the valuation that we want when we go out for the next round, whether that's a B, a C, a D, or whatever letter of the alphabet.
And Connor, we haven't heard from you yet. Say a company, maybe borrowed some money during the pandemic. Other than some of the options that were kind of mentioned to move forward, what are other options for possible post-pandemic restructuring?
Well, I mean, I think it's a really interesting time in the credit markets as interest rates heat up. I think LPs are looking at reallocating. They're kind of selling off their equity positions, locking in those gains, and then deploying it into debt structures, whether that's credit funds or corporate facilities. I don't know. Is this on? You guys hear me?
What about now? Whoa! All right. So anyway, what I was saying was the LPs or the investors in a lot of these credit funds are deploying more and more capital into credit facilities and away from equities. They're selling off their equities, locking in their gains, and redeploying that capital into credit funds. And what that means is that there's a lot more credit vehicles available for entrepreneurs. I think that credit has got maybe a little bit of a bad rap because obviously people are nervous about putting debt on their company. But the reality is that non-dilutive capital or capital that doesn't sit on the cap table is a great resource for people. And I really think that there's a plethora of funds and focuses out there that provide all kinds of different creative debt structures. And it's a good time to be looking at those options.
Piggyback on that as well. It's with the times that we're in. The dreaded R word comes around a lot more often now. So there is that thought, of banks being a little bit more tight in terms of how they deploy their capital, and so to your point, Connor, I think credit funds are definitely a good alternative to look at and at your disposal if you're an entrepreneur.
Okay, then with that, Connor, what does debt restructuring process, what does that actually look like?
If you're looking at restructuring debt?
Yeah.
So, okay, let's talk about what that is. So that means you have a note or you have a loan and you're not happy with the interest rate or the terms of that, or maybe you're looking for additional runway. Maybe the business advanced or changed. So all debt restructuring really means is swapping out one debt facility for another. And, in a way, we do have rising interest rates, which means there's more investors entering the credit markets with different facilities. So it's a good time to shop around. So if you do have a debt facility or you're looking for one, and maybe the only avenue you have is the SBA, great, explore that. But there's a lot of stuff out there, and debt restructuring is available to anyone, and it just means swapping out one piece of debt with the other.
If anyone wants to add anything, please go ahead. If not, I got a question.
I would, add our perspective on that, and it's a little bit different. And, when we provide a credit facility to a company that's, raising capital, typically when they raise that next round of capital, we're going to redo that debt facility again, right?
Yep.
So in a sense, that's restructuring the debt as well, triggered by that next equity raise.
Yep.
And to add to that, there are specific debt funds out there that are focused on, turnaround situations where if it's a company that is struggling and, is looking to restructure their existing debt, they could be an interesting option as well. So there's all sorts of funds out there for that.
And for our audience, remember, at the end, we are going to have Q&A from the audience. So please write down your questions on anything that you think might even if it's a little off topic, I'd like to stump these guys. So, Armello, question for you. What should someone be looking for or thinking about when they're looking for that lender?
Yeah, I think a great question. I mean, to me, I think, relationship is key. The ability for your lender to not only get the deal done, but to grow with you and your company and scale with you. I think all of that is very important, and that it's not just transactional in nature, but that they have a real solid understanding of your business, and can be with you not just now, but 12, 18 months from now. So to me, relationship is key, and obviously the ability to get things done. When you look at the private credit world, I think one consideration to have if you're looking there outside of banks is, their ability to deploy capital. How much money do they have in their fund? Have they, demonstrated success in the past? How strong is their credit team? So those are all, I think, things to consider if you're looking at that route versus bank lending.
Well, I mean, I don't really have anything to say, but I'm happy to say something. I mean, I think that one of the things to remember is that business is so fluid. And like Armello pointed out, you really want to have an open flow of communication with your lender, whether it's looking at making an acquisition or acquiring something or restructuring or just sharing a developing dynamic in your industry. Your lender really needs to be your partner and be someone that you can turn to and provide more than the mandated quarterly reports and really sit down and understand the business, because ultimately they are a stakeholder, even if they don't sit on the cap table, and they're an ally in the success and growth of the business.
Yeah, and then to add to that, in the banking side of things, relationship is paramount as well. And in the past few years, when things were rosy and everything was up and to the right, maybe the relationship didn't have as much value because, hey, everything's good. What do I need from you? But as things are changing and as things are going to get a little bit tighter, to have a relationship with your banker is key to your business. And, there's a lot of different banks out there, and different banks have different strengths. I mean, we're a great option for companies that are venture bound or venture backed. That's what we focus on. If you're a concrete company and you're dealing with government contracts, then, maybe that's a different bank that you should be talking to. So, to have some intention as you're out there looking at the bank that's going to be best for your business, but also, who is that banker? And am I going to have a relationship with that banker? Good banking is a lot more than just how easy is it to open up an account. So, as a bit of advice, as everybody's out there working, building their businesses, those are important relationships to have. And I think they become even more important as things tighten up and as we go through this winter that we are experiencing here, and for how long that's going to go.
Yeah, I would just quickly add, I mean, your banker is your advocate, right, within the bank. If you want to be able to get things done, someone has to be in there internally fighting for you, because they're the ones telling your story. So be transparent as possible. And even if it's a challenging time, like, if you're not meeting a covenant, it's going to come out eventually. And it's better to have that story told so that your banker can advocate and fight for you versus it come up as a surprise when your financials are due.
So you'd mentioned something right there when you're not meeting a covenant. Can you talk about that a little bit, just in case that's not known for people here?
Yeah. So when you enter a loan agreement, there's certain covenants that you as a borrower will abide to with the bank or whoever your lender is, whether it be, covenants around profitability or debt service coverage, things of that nature. And so, the bank or your lender will collect your financial statements at some regular interval, whether it be quarterly or annually, to test those covenants. And so as they do that, if there's a violation of those covenants, technically, then you're in violation of your loan agreement. Now, that being said, I think no bank or no real lender is out there to, call the loan and take over the business. I don't think anyone's in the business to do that. But you can think of that as kind of a come back to the table moment so that you can kind of figure out what's best and what makes sense moving forward.
In essence, they're triggering points that show that there's something going on in the business that we need to talk about.
Okay, then with that, say someone were to come to you for a loan or assist in raising growth capital, and if you'd like to answer maybe first by saying, they would come to me for this, what type of financial due diligence would you ask or would you perform on them before working with them? I know it's a long question, but Connor?
All right. Well, so I think this is really where potential borrowers or potential parties to a capital transaction can really make the difference between an easy process and a difficult process. The due diligence requires all of your corporate documents, articles, yada yada yada, your financials, past, present, your cap table, who is the major shareholders in the company, and then any and all material contracts that might impact the business, litigation, anything that might be creeping around there needs to be disclosed to your capital source. And it helps if you're organized. It helps if you have a template to build out a data room. The data room is something that gets thrown around. People are intimidated by it. You shouldn't. Just use Box, use Dropbox, use anything that can be password protected. But I would say that you want to over disclose so that people get a true sense of the business. If you just have 3 years of financials and a couple PowerPoints and a sales deck, that's not really going to give anybody enough context to potentially make a lending decision or investment decision. So my thought would be, you want to be able to present and prepare to the extent that there is nothing else that anybody would ask for.
Yeah, and in our business, it's very similar as far as the financial information that we're gathering. I think one of the things in our business, since we're tending to lend to companies that aren't making money, that are burning money, is we're looking at, that burn multiple a lot, meaning, how many dollars does it take to create a new dollar of revenue? Part of our relationships as well are with those VCs, those investors. And we know that they're going to do a much deeper dive into the technology and into the team and into the market than we ever would do. So having that relationship with the investor and the trust that, hey, we're in on this and we're probably in on the next round too, is a big part of our due diligence as well, is understanding what the investor thesis is in there besides what all the financial information is telling us.
And I would just quickly add on our end, audited financials for us are, what we would look for. And in a lot of cases, and very common amongst the middle market, a quality of earnings, especially irrespective of M&A transactions, are going to be, asked for as well. And to me, that's particularly important in terms of those transactions. You can think of it akin to, if you're selling your home, you do a home inspection, right? Maybe you do that proactively, and it builds confidence for the buyer, so that they have some confidence in what they're buying. So that would be another way to look at that.
And then Mark, what's the current state of capital raising right now?
That's an interesting question. I can speak from what I've been seeing and hearing out there. Things are getting tighter. It's. I think I said it earlier. I think the biggest news is that the leverage has changed. For the last few years, founders have had it really good. They've been getting multiple term sheets. They've been getting to have, the valuations that are making everybody smile. And that's changed. The leverage has shifted towards the investors. And a lot of it comes down to, that remaining month's liquidity. How much burn do you have left? And if you're in a position where, you got 6 months less of burn left, you're going to be in a real tough place to go out and raise new equity. You're probably going to get a down round. It might be an inside round, and that can be tough for everybody involved. There's still a lot of capital being raised. There's still a lot of dry powder that's out there. But what I've been hearing VCs say is they're just taking a little bit of a step back and taking a little bit of a breath. And whereas they might have been deploying a fund in 5 years, maybe they're saying, well, we're going to deploy this over 7 years now. We're going to slow down the pace a little bit, and we're going to see how things happen. So, companies are still getting funded. They're still going to be getting funded. But I think, the leverage has shifted out there in the in the equity markets.
I would say that there's still a lot of competition for good deals, probably more so than a year ago. So I think one of the interesting things that's happening is that for some companies that hit certain benchmarks that are sort of agreed upon to be attractive to different funds, there's a lot of competition still. And for companies that might not fit into those buckets, there's kind of a dearth of deals being done. And so I think that as LPs instruct their funds to be a little more conservative and stick to a real solid and refined investment thesis, you're going to start seeing, I think you're going to start seeing entrepreneurs need to explore multiple alternative funding sources and build a more complicated capital stack.
Yeah, and certainly, it's investors are going back to some of the fundamentals before. I mean, over the last few years, it's been growth. Now it's a little bit more is there a path to profitability? Can we see some period of time in the future where we're going to actually, have EBITDA to talk about? But I think, the fundamentals of the business are becoming a little bit more important maybe than they were previously, when it was how much gas can we pour on the fire to get the biggest fire that we can, right?
Well, with that though, I mean, for the last, I'm not sure, year or 2 years, kept hearing about all this dry powder, all these private equity groups, all this money on the sideline. Why do you think so much money sat on the sideline there for so long? Or is it, or wasn't there, and just the rumors weren't true?
I think it's a combination of two things. So one, when people hear about dry powder, what really it means is that the fund sizes are getting bigger. Over the last 10 years, the amount of capital that funds need to have is just shot up. So that means that the deal sizes need to be bigger because you got to deploy all that capital. And so that means you're not going to be looking for smaller deals to have multiple deployments. You're going to look for larger deals where you can kind of, get the work done and get the funds placed. And so I think that one of the reasons why there's so much dry powder is you raise a massive fund, then go into a recession, and suddenly the deal profiles don't look that good, and you can't put as much capital to work. So you're going to just sit it out until those deals come back around, and then you can write the checks that you need to.
Okay, good answer. Stumped went silent on the platform.
I would just add to that too. Probably a function of what contributed to that. Just the lower interest rate environment we were in, right? And so LPs looked at credit funds and thought that was an attractive opportunity for them, and started placing more of their capital there. And to your point, that's kind of how that unfolded.
So when we're in uncertain times, is it a good idea, possibly to look globally for investors? And if so, how would currency risk play a part in your thought process? Connor, you nodded your head, so you get to go first.
Okay. Well, so I think that the investor base has certainly become more and more global. And I think one of the benefits of working with investors in other markets is they may have seen inflation before, and they may understand how to work through inflation. Particularly if you look at countries like Latin America, places in India, all over the world, there's been sort of inflationary periods where investors have been able to deploy capital and make a profit. So I think that in terms of that insight and understanding, it's really good. In terms of currency risk and how that factors out, I mean, currency risk has always been an issue, particularly if you're a US-based investor investing overseas. But I think that there's plenty of global players that are doing cross-border debt lending, particularly around heavy equipment, around minerals. Oil and gas is a big one. There's a lot of money out there for international cross-border transactions. And, I think that it really, you need to have a business that requires that kind of capital source for you to really tick those boxes. But if you happen to be in that area of business, going cross border is a great way to go, particularly with the inflation expertise.
Well, I certainly know that VCs are looking globally for their deals. And we're seeing a lot of companies that are based in Europe or Latin America who have been funded by U.S. VCs, and now that they're going to bring their operations to the United States. And that's actually 4 or 5 companies that we're talking to right now who fall into that bucket, right? And it's at least with the VCs that we're working with, they're saying, we're going to invest in you, even though your development team's in Spain, but we want you to come to the States. We want you to set up shop there, and really your go-to-market's going to be done from here. So kind of a flip side of what you asked there, Sean.
And as a reminder, commercial banks have teams dedicated to stuff like this in terms of managing FX and currency risk. So to the extent that you have a relationship with a commercial bank, I would advise, reaching out to them.
Oh, and we're going to open it up to the audience in just one more question. So if people want to take notes of what they want to ask, just hold on one second. If we could get Tim with the microphone and that ready, that'd be fantastic. Or Brian with the microphone ready, that'd be fantastic. So quick question for the panel. When someone comes to you looking to raise money, what's the difference between when the money is going to be used to grow internally versus the money going to be used to maybe acquire another company, an acquisition? How is that conversation different?
Well, I think, there are 2 very different things, right? Internal could be a new product line, something. Obviously, internal, external could be an acquisition. So from a lender's perspective, a lot of it will come back to kind of similar to how a PE firm will look at it in terms of IRR, right? Like what's going to be the benefit for the borrower, either way. It's almost like the build versus buy kind of strategy, if you're going to do something internally versus buy externally. But for us, as a lender, it'll come back to the fundamentals, I feel like, where you're still going to look at EBITDA of the company, what's going to be the projected EBITDA, whether it's internal or if you're bringing on a new target acquisition, what will be the end result, right? And so we'll have to approach it both ways in that same manner.
And Connor, I would like you to add, but just for everyone out there, remember our last panel, if you had questions about EBITDA, please ask Bharat and Ben, who are in the audience, that will be here throughout the day. So bother them on that one. Okay, Connor, please continue.
So yeah, I think that sticking to the fundamentals is good. The big thing to realize for potential borrowers or for business owners is what transaction they're looking at. And so when people are talking about, I want to grow my business, and they're talking to someone about extending some line of capital to fund that growth, and then they realize that their growth is really going to come through an acquisition, you've kind of not gotten off to the right start because you've confused the type of transaction that you're involved in. So realize, I think, that from an institutional perspective, an acquisition is an acquisition. They're done every day. You're looking at the company on sort of a standalone basis and trying to decide whether or not the capital required to acquire that company is gonna generate a return. And whether you're doing something internal, then you're looking at, like you said, a lot of it at the end of the day comes back to the free cash that you have so you can service the debt. And I think that it's just the trick is to know what kind of transaction you're looking for before you approach a bank or institution seeking funds.
Yeah, and add on that, our venture debt, probably after runway extension, acquisition is probably, one of the most popular reasons that people use it. And, in the tech world, there's a lot of those, what they call acqui-hires, right? Where you go after a company really because they got 2 or 3 engineers that you want to grab and you want to get onto your team, right? So, I agree with the fundamentals that the panelists have discussed as well. And that's, again, an important time to have that relationship with the banker and say, this is something that we're thinking about doing. We're thinking about drawing down the debt to do this. What's your take on it, And ultimately, the fundamentals, are you going to be able to afford the debt service, or is that new acquisition going to bog you down where, you're in a worse place than you were when you picked up the company?
Yeah.
All right, and with that, let's open up the questions from the audience. We have a question from front row. Nick, could you wait till we get the microphone to you? Tim, yeah. Oh.
Nicholas with Community Central. Great panel, by the way. Thank you, guys. Mark, you mentioned that venture debt is extending the runway. Does that mean it's a down round? And if so, how do you calculate the valuation?
Well, it doesn't necessarily mean it's a down round. It might help you avoid having to do a down round, right? Because if you're getting to a certain point, and let's say there's a milestone out there on the horizon, and if we get this contract with this particular company, that's going to pump $1 million of ARR into our company, and suddenly we're going to have this other valuation. But hey, things have slowed down. It's taken a little bit too long. So, now we can draw down on that debt, still pay everybody, still pay our bills, and have that little bit of time to close it. That's really kind of the idea of the debt being able to help you avoid having to do a down round, because it gives you that extra time to reach whatever milestone that you're looking for.
I had a follow-up question as well. So I'm curious about when is the appropriate time for a company to come to Pacific West, for example. Like take Serge Amazon, who runs FinPro. They just landed a terrific partnership with MasterCard or American Express. MasterCard. These guys are going through the roof, but they're still in the early stages. Would they be a good fit for your bank?
If they're an early stage, company that's looking to raise venture capital in their future, then for sure. Our model is really built for companies that want to go on that venture journey. And as far as what's the best time to get venture debt, the best time to get venture debt is while or right after you've raised your equity, right? Kind of that point where you don't need it. That's the best time to go get it.
All right, next question, Ron, and then to the back.
Ron, I would like to ask you 2 questions. One is about underwriting guidelines. Given the turmoil in the equity markets, have underwriting guidelines gotten stricter? And then the second one is about overall cost of debt. With interest rates going up, our risk premiums also making that up.
So can you repeat the first part of your question? I'm sorry.
Underwriting.
Underwriting. Yeah, I know for us, our underwriting, so we're a little bit unique. We're a startup. We were formed about 1.5 years ago. Our underwriting guidelines have stayed the same. We also don't have a legacy portfolio kind of weighing us down, if you will. So, our from that sense, I think it's solid. I can't speak for banks or other banks. I think there's a sense that, things could start to tighten amongst banks. But I wouldn't want to, speak for anyone
I
to
think
that point.
Just, springboarding there with some of the larger banks that I've dealt with, which are sort of like large nationals. Most of them I've come across in workout or turnaround situations, and now we're starting to see the underwriting guidelines change. And there's plenty of deals that have been passed around these banks like a bad penny, where they just go from workout group to, they're on fledgling legs, they're back in the workout group, then they go on to liquidation. And one of the other things that's really kind of, I think, impacting is that the Article 9 sale of assets outside of bankruptcy has gotten a lot of scrutiny. And so now you're forcing banks that have a company that's in default to either exercise Article 9 to go ahead and liquidate the assets outside of bankruptcy, or to push the company to go and file. And so I think no one wants to be the bad guy. It's no one's intention to do that. And no one wants to carry the risk of an Article 9 sale outside of bankruptcy. So a lot of these banks have had a really long road with some of these companies that have been in turnaround or in default for an extended period of time. And I think that's finally getting the underwriters to make some policy changes.
And I think naturally, you mentioned risk-based pricing. That could be a result of that. Banks have all sorts of parameters for different industries, different borrower types, where they assign some sort of score or metric. And as conditions change, that could change and follow depending on what industry that the borrower was in, for example, and that could affect their pricing. So yes, it could definitely impact that.
All right, with that, we have one last question for the audience. Before that, though, I would like to remind everyone, there are QR codes on the sides where the snacks and foods are. If you'd like to follow up with any of the people on the panel, please feel free to scan the QR code. It'll take you to a Google form where you can put your contact information and the request at the topic you'd like to cover to reach out, and everyone will get it, or all the panelists will get that information within the next 24 hours. So with that, last question from the audience for this panel.
Thank you. I'm Matthew from Crew, and I was wondering, what is like the earliest stage that you start to see debt financing coming in startups, whether it be ARR or EBITDA? Like, at what point do you think, like, okay, let's really start to explore this?
Well, I think it kind of depends, right? And it depends on where you're going to get the financing. For us at the bank, we might put a debt facility on a seed round, right? But that seed round is probably going to be a $15 to $20 million seed round that we know the investors on it, and they're saying, hey, we really like this company, take a run with us, right? Typically, it's A and beyond, but when we look at it, it's that total amount of equity, because we're going to lend some sort of percentage of that equity, right? So the bigger rounds tend to get more equity, right? There tends to be a little bit more, to piggyback on the underwriting too, later stage companies, there's a little bit more that we can underwrite too. There's revenue, there's contracts, there's other things. When we're looking at those earlier stage, the seed or even the A rounds, where there isn't that kind of metrics, then it's a little bit more art than it is science, right? So it could be early as a seed, but it would have to be, as we say, right down the fairway for us to do something that early.
I think one of the other things, asking this question, when can a startup start looking at debt? It's sort of like, when can someone take out their first credit card? And I think the answer is that there's all kinds of different credit facilities out there for every borrower. And if you're responsible and prudent, you can find something that fits. There's asset-based lending, there's inventory finance, there's PO finance. I think really the thing to do is to look at the overall business strategy or business model that you have, and what are the tangible characteristics that are solid enough to have somebody lend against them. And this is kind of interesting, because I think this is one of the things that can get young entrepreneurs or early stage companies in trouble, is they often don't understand the obligation in servicing those loans or debt. And so this is where there's maybe optimistic entrepreneurs that over leverage a PO, and suddenly they have death spiral financing that just knocks them out of the box. And so the short answer there is, there's all kinds of lending available for your company. You can find good lenders that'll work with you, and as long as you're transparent and honest with them, and understand what you're getting into, you can manage it pretty prudently.
Cool. Thank you.
All right, and with that, last question for the panel. 30 seconds each person. One takeaway the audience should know, and how's the best way for them to get in contact with you?
Takeaway for the audience is, I'm available. I love talking to entrepreneurs and business owners, because I feel like if I can't help you, maybe I know someone that can. Best way to reach me would be through those wonderful QR codes that you guys have set up, what organization that is. But I'm also on LinkedIn and pretty active there. And if you mention that you saw me here, I'll connect with you there, and we can do that as well.
Cool. I think the one takeaway, there's a lot of doom and gloom because of interest rates, because of COVID and all of this. Obviously, there's tough times that are ahead of us, but the business environment is still pretty good. Deals are getting done, investors are putting money to work. There's a lot of great lenders that have deep pockets that are ready to do deals. So let's go, let's do this.
Stole my thunder, Connor. I was going to say, there's a ton of capital sources out there, and hopefully we provided a sense of that. So be diligent and go out there and reach out to us. You can reach out to me. I'm on LinkedIn. My email should be in the QR code somewhere. So happy to talk.
All right, and also for everyone out there, you'll get a link in the next 24 hours that has access to a Google Drive that has every one of these people's one-pager, every one that has submitted a one-pager to me.
You got one pager from me.
Yeah.
I'm a mystery.
Too much for one page right
It's a novel.
All right, with that, I'd like to hand the mic off to our MC, Brian.
All right, thank you, Sean. Let's hear it for our panel.